In part 2, we are going to be looking into how and why to record depreciation, and also an important element of impact of depreciation in financial statements. So why do we need to record depreciation? We already mentioned that we need to reflect this loss in value of asset in the accounting period. And we know that the asset loses its value over time, and we need to allocate this loss of value reflecting towards the original price bought. And this is simple compliance with matching accounting principle, which recognizes expenses in accounting period. It helped to generate revenue. In the year, let's say 2025, when we purchased our car for business purposes, we use this car to generate sales, to visit clients, or to show apartments if we're working in property business. So we have continuously used the business asset to generate sales, to generate revenue. For us, it's an expense. We know the car we used is now losing its value. So by the end of the year, we have to reduce the original price by a certain percentage or a certain amount. And that is the reason why we need to do it, because we need to reflect our costs to revenue in the same accounting period. And the reason is that it produces the financial statements are accurate and reliable for review, especially because of profitability. And there are other elements we're going to look in a second, but it's important to understand the matching accounting principle, where we recognize expenses in accounting period where it helped to generate that revenue. So what is the impact of depreciation on various financial statements? If you have any questions about balance sheet or any other statements we're going to discuss in this course, I would highly recommend you to look back into Introduction to the Bookkeeping. It's a free online course. You can do it in half an hour. It's very straightforward and it's for beginners as well. So any questions about what is balance sheet and what other elements such as asset and everything else, I highly recommend you to check the course. It's on the website learnbookkeepinguk.uk. So let's go back to the balance sheet statement. We reflect the original cost of an asset when we buy it, right? And we know that we need to reduce the original cost because at the end of a year or at the end of 2 years, the value is different. So we use accumulated depreciation through years. So it would be 5 years, 2 years. So we have all amounts of depreciation combined in that particular amount. So this shows a realistic value of an asset, original cost less accumulated depreciation through years. And investors can rely on this data to make decisions on capital expenditure. For example, if we need to replace expensive assets or any business asset, which is vital for part of the budget and planning for investors. When we look into profit and loss statement, we will see yearly depreciation cost as expense, and this expense reduces accounting profits. Don't confuse with accounting profit and tax purposes, because depreciation is unadjusted. They are replacement with capital allowances, get more complex, but for the sake of the profit and loss, it is expense. This deduction allows to effectively assess the cash flow and also ability of a business to pay for its expenses and loan, and also to pay dividends to their shareholders. So ultimately, depreciation provides a reliable value of an asset, shows the actual profit for a year. It's important to make investment decisions to replace assets, and better transparency and accuracy of reporting. So let's recap. Now we know why to record depreciation. We know a few impact areas on financial statements such as profit and loss and balance sheet.